As David said, we're going to be discussing, well, the name of our topic is transparency in direct lending, but as I listened to most of the panels today, almost all of them touched on transparency in one way or another, and it made me question what really is the definition of transparency, and what is the marketplace looking for? What are investors and borrowers looking for in terms of transparency? So I think we have a nice panel here to touch on that topic. So I'm going to start by letting them introduce themselves. Christine?
It's on? Is it on?
They should all be live.
Sorry. My name is Reilly. I am Chief Risk Officer of LiftForward. We're a 3-year-old company providing small business lending to a wide variety of small businesses in diverse industries. Prior to joining LiftForward, I spent a long career at a big commercial finance company called CIT, which the prior speaker failed to mention that CIT was also an old non-bank finance company, once called a specialty finance lender. I ran their small business lending division there for 5 years, and prior to that, I headed up their corporate M&A group and was a business segment CFO and was their chief audit executive for a short period of time. So I've experienced risks from a lot of different angles.
Thank you.
Hi, my name is Azba Habib. I'm Assistant General Counsel at Kabbage. I've been with the company for about a year now. Kabbage is an online lending platform, and we provide access to capital for small businesses. Currently, we only work with commercial and small businesses, don't do consumer at this point in time. I think one of the more unique things about Kabbage is really our technology and the fully automated underwriting experience. So about 95% of our customers have a 100% automated experience. The process takes anywhere from 7 to 10 minutes. We've been around since 2009. We were in beta for the first 2 years, really focusing on building the technology, and then we launched out of beta in 2011. We've been active in the SMB space since then, and then last year we actually launched what's called the Kabbage platform, which is our SaaS offering that we have put out in the marketplace, and we've worked with a number of large financial institutions to license our technology, and we're currently live in 5 countries worldwide.
Hi everyone, my name is Chi-Pei Tseng, and I'm the Director of Business Development for PeerStreet. PeerStreet is a marketplace platform for real estate debt. We've taken a different approach to this space versus other companies that we're competing with, in that we don't originate our own loans. Instead, we've created a curated secondary market for private money real estate loans by forming partnerships with private money real estate lenders across the country. We launched out of beta about 10 or 11 months ago, and we funded about over $100 million in loans since then.
All right, so I thought we would start with the front end of the experience and the product structure, and how product structure influences the investor experience on the front end in terms of transparency, and what characteristics are you disclosing to the investors and what they're looking for. So maybe we could just talk a little bit about the different ways your platforms are satisfying that request. Anybody want to start there? Chris?
Sure. We are an online lender. Mm-hmm. Our investors are looking for competitive yields. All of our investors are institutions. They have an expectation of, I would say, complete transparency. So, we are essentially an open book. If we're talking to a debt or an equity investor, they will have a data tape on our portfolio. They will understand and review our credit policy. We are also audited annually because one of our investors is a public company and requires an annual audit. So we share the results of those audits with our potential investors. We have a code of conduct that we think is very important, especially for a young company, to set the tone at the top, and we share that as well.
So starting with product structure, currently we offer 6 to 12 month loans through our platform. We also are not a direct originator, so we work with a federally regulated bank out of Utah that issues all the loans on our platform. So we really truly function as a platform in that capacity, and more specifically from a legal construct as a program manager, which is a pretty well recognized structure, particularly in the credit card space. So going back to the product structure, it's somewhat of a unique construct, and the reason I say that is because it's a hybrid. So there's the 6 and 12 month loan, but it's sort of within the umbrella of a line of credit. So the way it functions is that you get approved for a line of credit, and every time you choose to draw on that line of credit is an independent loan. So new asset class, line of loans. It's sort of a different product construct in that regard. And then I think that's also important because the way we structure our technology is that it's a continuous plug-in to the business, and that really facilitates the underwriting process. So what I mean by that is usually when a small business comes to Kabbage and they apply for a loan, the reason it's such a quick experience is because we underwrite them based on third-party verified data sources. So historically, one of the more difficult things in our space is fraud, right? People make up their bank statements. Businesses do this. And so instead of actually asking our customer, the business, to put together their financial statements, we put that together for them. And we do this through API connections to a number of third-party sources, including their bank account information, but other sources like their payment channels. So, for example, Stripe. As well as some of their revenue channels. So we'll connect to their eBay API, their PayPal API, their Etsy API, their Amazon API. We have over 10,000 data points that we look at through various APIs. But the reason I mention that is because it gives a continuous connection. So we don't just underwrite with information at one point in time. We maintain that continuous connection. In fact, if you choose to disconnect, that could potentially be a breach of your contract. So it's that continuous underwriting that occurs that I think really distinguishes the underlying collateral, because we can see at any given time what the health of the business is, and then we can also pick up on macroeconomic factors. So I think from an investor transparency perspective and just a risk perspective, I think we generally distinguish ourselves on the underlying collateral and that continuity of information that we're able to see and present to investors. So as far as risk goes and transparency goes, it is a commercial product. We don't issue any consumer loans, and that's the area that's seen, probably, to continue our daily analogy, the most turbulence. And in addition to that, it's a bank-issued product, and there's this continuity of connectivity. As far as investor transparency goes, I think it's very similar to what Chris said. You know, we provide historical statistics, we provide loan tape, but also someone mentioned this earlier today on the transparency panel. There's full cash flow disclosure. So it goes back by vintage. You can see exactly how much came in, how much went out. You can verify it across loan documentation, but also information from our financial institution about payments. So the ACH files, right? Because that's important at the end of the day. You want to make sure the bank's actually getting the money that the cash flow says that they're getting. So it's a variety of disclosures. We are more in the direct lending segment, so it's not standardized. I think even in the marketplace side, there is no official standard, but I think in direct lending, it's a little bit even more ad hoc, because our investors, depending upon their due diligence process, can ask for a lot of information outside of what we normally disclose, and we will accommodate those requests.
The only thing I'd want to add is that in order to make sure that our investors, don't have a concern about adverse selection, we do have a blind allocation. We don't hold loans on our balance sheet, although we do take some first loss to keep some skin in the game, which keeps things healthy in terms of team relationships.
You both touched on some topics that I want to circle back to in terms of the standardization of data and regulating that, and then also allocation of loans. And I was going to ask actually Chi-Pei about this, because your product structure is actually very different, right, in terms that so I thought you might want to address that as well, and then provide some insight into how you are providing investors with assurance that there aren't any holdback of loans for preferred investors or for self-investment.
Sure. Just to start off with what kind of loans we're providing our investors. We're mainly buying high-yielding, short-term real estate loans that are typically first lien. And to date, most of our investors have been accredited individual investors on our platform. And the way we're structured with this distributed correspondent lender network, we want to be able to provide insight into these lenders to our investors. And so with every loan write-up on our platform, you have the originator's name right next to it. And even further, we provide the lenders' biographies, their principals' backgrounds, and as well their track record on our platform. So if a loan goes bad, our investors are going to be able to see that. And this also provides a great risk mitigant against adverse selection on our platform on the part of our lenders. This type of reputational risk, we've seen it really working in terms of them working with us closely to provide their highest quality loans.
Okay, then, did you have something you wanted to add? No, going back to Azba's comment about standardization of data, do you think that determining a standard for this industry will provide assurance or transparency to investors? And if so, who determines that and who enforces that?
Oh, go ahead. You can go first this time.
So, I mean, I think the unequivocal answer based on the previous panels is yes. I think some level of standardization will be really, really beneficial to this industry, both on the retail side as well as the institutional side of the house. I think it's a very, very difficult conversation to have. We had folks make some really good points about just differences in reporting, what counts as a delinquent loan, what counts, just how you interpret various credit reports, how your disclosures are structured, what types of disclosures you give, and how to standardize them, given that certain disclosures may be more favorable to certain product structures or program types than others. So I think it's a very, very difficult conversation to have. I think, we can see what's been done on the borrower side. So when I think of transparency, I think of transparency across the spectrum, right? There's borrowers on this side of the house, and then there's investors on the other side of the house. So most recently, and it's still called as somewhat of an experiment because it hasn't officially gone live yet, and it's sort of still a work in progress, but Kabbage was one of the charter members of the Innovative Lending Platform Association, ILPA. And one of the first initiatives of this particular trade association was to create something called the Smart Box, and that stands for straightforward metrics around rate and total cost. And it was a self-regulatory effort at transparency, because every regulatory meeting that I went to or every political person that I spoke with essentially had the biggest concerns around transparency and what we were doing as a platform to provide that to our borrowers. So if you look at the consumer side, you've got the Schumer box, right? So it's essentially an homage to the Schumer box, but in the right context. So you've got APR disclosures, which is a big deal considering we offer a 6-month product that's not annualized. And so we made a very explicit decision that we were going to disclose that, and we were going to do it in a standardized fashion. So we work with a number of our peers, competitors, even in the industry, to create a standardized disclosure for all borrowers, all small business borrowers, because none exists at this time. And there's a number of metrics that are disclosed in there, APR being one, total cost being another, monthly fees, cents on the dollar, things that we surveyed small businesses cared about. And one of the trickiest things in this process was methodology. And I think folks touched on this earlier, and I think this holds true for the investor side of the house. How do you standardize the calculation methodology? You can have the same metrics, but it's very easy to fool around on the back end. So we actually had to work with a third-party service provider, because we also had antitrust counsel in this process who said you can't share your calculations with any of your competitors. So we had to have a third party that we sent all our back-end calculations to, and they had to certify that APR was calculated pursuant to Reg Z, which was the model that we chose to use, which is what you see in the consumer side. And there was a lot of very vehement debate about what types of fees would or would not be included. And I think that's just a very small window into the kinds of granular, painful, awkward conversations you're going to have between platforms when you try to implement standardized disclosures. But I think I'm really excited to see how this ends up, because we've just finalized it. All the participants have gotten approval from their issuing banks, and it's going to go live in October, and it's going to be in the loan documentation of all platforms that are participating. But I think that was an instructive exercise in how excruciating the process is, but it's not undoable because we've done it on the borrower side, and I think there's opportunity to do it on the investor side.
I'm going to answer this a little bit differently. Maybe it's a little bit more high level, but I think the gentleman beforehand from SQN kind of nailed it. On the front end, in terms of the credit analysis, the way we approach credit is just based upon the fundamentals. And yes, the technology gives us more information, a lot more supplemental information than we ever had before, including our ability to tap into social media platforms for an individual to, verify identity, et cetera. But it's good old-fashioned, credit underwriting. And, we do it faster because the technology, it's more complete. I have a dashboard that, literally gives me, every piece of information that I would want to know about a prospective borrower, assuming they've filled the application out, in a complete way.
Always challenging.
So on the front end, I don't really think that there's a whole lot different. And, our credit criteria, whether it's time in business, use of proceeds, cash flow, collateral, those fundamentals are described in a great amount of detail in our credit policy. On the back end, I do think that there's probably some room for standardization in terms of how you report delinquent loans. When do you consider a loan delinquent? When would you write off a loan or reserve for it? Especially when you have such short-term loans. So we get into a lot of conversations with our investors about that. There's a hell of a lot of difference between a 12 or a 36-month loan, which is what LiftForward does. And we basically finance through vendor partners such as manufacturers, retailers, and the like. We right now have a terrific vendor relationship with Microsoft where we are providing financing for their Surface Pro tablet. But on the back end, I think there's some room for improvement. There are standards out there in the industry. There were standards out there for specialty finance in the 20th century. We can look to banking standards, which are well known. There's usually been more wiggle room in the specialty finance, alternative finance space in terms of when you ultimately need to write off a loan, work out a loan or whatever. But on the back end, I think it's a little bit fuzzier in terms of what the standardization in the industry is.
Okay, we have a question from the audience. Do you manage currency exposure, and is cash drag ever a challenge?
LiftForward is not currently making loans outside the United States.
Same is true of Kabbage. So the bank that we work with in the U.S. only issues U.S.-denominated loans. Our platform's licensed, but it's a SaaS model where it's labeled for it's white labeled for banks, and they issue in their own currency.
Same here. We're U.S.-based at the time. But I did want to touch upon standardization of data, the last subject. In our market and private money loans, there's traditionally been a very fragmented, opaque industry, not a lot of public data available. And from the way we're working, by partnering with multiple private money lenders across the space, potentially hundreds, we'll be able to provide that type of insight for our investors and to be able to standardize that data. And we're already starting to do that right now by creating the technology for them, for our partners to be able to upload their entire loan books for us to analyze and to standardize.
One question that I had for all of you. So third-party data companies, we heard from them earlier today. How and what role do you see them playing in this process of disclosure and analysis to supplement or add to transparency?
I don't think they add much from a disclosure perspective. They're certainly part of the credit analysis process. Mm-hmm. We use a wide variety of data companies, whether it's, FICO, SBMS, Experian, we use LexisNexis. Again, a lot of these things are, these companies are, have always been a part of traditional underwriting.
Right, I think
Maybe I'm
I'm
not
talking
understanding
about,
the
yeah, I'm
question.
sorry if I wasn't clear. I think I'm talking more about third-party providers that are analyzing data within this industry, data provided by you, such as on loan defaults and your borrower base and so forth. Does
speak
their
to that,
independence
yeah.
add value?
The only thing I would add is that we see ourselves as a credit analysis company, and so we own that process. We don't have a philosophy of outsourcing what we perceive to be our core competency. Now, on the servicing side, we outsource our servicing. But, the front end customer acquisition and, credit underwriting is something that, we feel that, we need to own pretty tightly. We wouldn't outsource that.
Okay.
Or a big component of it.
So I think we view ourselves very similarly in that we are at our core a technology underwriting platform. We do a pretty good job using a number of third-party data sources to do the underwriting, but nevertheless, if you're working with large-scale institutional investors, there's going to be an expectation that you have third parties verify your data. And I think independently, I suspect all our companies feel that we provide adequate disclosures to our investors, but I think a gentleman made the point early that disclosures are useless unless you have adequate scrutiny. And I think that scrutiny is really important. So when I was coming on this trip, I asked one of my data guys, I'm like, hey, can you send me a copy of the investor reports that we normally provide, like everything from the cash flow to the portfolio snapshot? Within 5 seconds, my Mac crashed. And I was just like, okay, maybe I need to upgrade to a Pro, I get it. But still, it was very obvious that like my poor little Mac couldn't handle any of that information. And I know that at the end of the day, a lot of the folks that are getting this information are not sitting there with their little MacBook Airs. But at the same time, I think digesting that kind of information and really coming up with valuable insights, I don't know if every investor is situated to do that. So I do think a lot of these companies play a role. I know our verification agent, every time we pledge a borrowing base, they do a sample set of 15%. On top of that, we have one of our lenders come in every 6 months because their investors require them to do that kind of diligence. And then on top of that, our facility requires that we have a third party come in to check to ensure that we're adhering to the terms of the securitization agreement, particularly around concentration limits and the like. So, we pass all those audits with flying colors, but I think it's a check the box, particularly when you're dealing with like pensions, because they're going to ask for that stuff.
Okay, I think we've
There's standard letters that you can get from these organizations. Once upon a time, I think they were called SAS 70s. I don't know what they're called now, but
SSA 16s.
Yeah, right.
Yeah. I think that, that's a good lead-in actually to, and we have a couple questions, so I'll try and get this out quickly. But Azba and I were speaking earlier, and one of the things I thought of as I was preparing for this panel is, we're always talking about the platforms disclosure and what they're providing in terms of data at the borrower level, either at the front end, at the initial point where you're investing in ongoing. But what about transparency or disclosures at the level of the originator or platform? And in particular, Chris, I think you made mention of this, implementing a code of ethics. Yeah. And maybe you'd want to comment on that, just given, the year that we've had. How assuring would that be to have in place to investors?
if I were an investor, I think I would like to see something like that in an organization. When you have young companies who are growing fast, the tone from the top is more important than ever, and something formal like a code of conduct. At LiftForward, we drafted a pretty comprehensive code of conduct that also includes credit laws and regulations, and we have every new employee sign it when they come in the door, and annually they have to read it and sign it again. Mm-hmm. People get in trouble when, and you typically don't have environments, at least at the early stage, where you have the type of segregation of duties that you would have at corporate. So I think that makes it even more important that employees understand what the expectations of the founder and the executive management team are.
Right, well, and an SAE 16 just adds credibility to that, right? In terms of
Exactly.
separation of duties and appropriate controls in place. Real quick, we have a couple more questions from the audience. What sort of investors are currently reticent of direct lending due to not enough transparency?
So I don't think we've had a major issue in this regard. So it's really interesting. I think vernacular matters particularly in the legal space. So there's marketplace lending, and then the area that we generally get dumped into is direct lending. And I think that's a little bit of a misnomer because we're not a licensed lender at the state level. We actually work with a financial institution that issues the loan. We have seen a pretty diverse investor base. We've particularly narrowed it to institutional. So we have banks, we have hedge funds, we've got pensions, we've got insurance companies, and just general fund asset managers. So we haven't seen any reticence in any particular investor segment.
Same with us as well. We haven't seen as much reticence of anything. If there's something that they need to know, we've been very, very open with our investors and providing our entire loan book and performance data as well.
The only thing I'd add to that is, and LiftForward is maybe not as far along as the maturity curve as Kabbage, but I think what our investors are, and I don't know if this falls under transparency, but they want to get their arms around what the ultimate loss profile is going to be, mm-hmm. And that is a difficult thing. People can argue that there are, databases out there that can, predict what, the loss profile might look like, for the type of products that, we're offering or any other company is offering. But, we don't have the vintages yet, and certainly haven't gone through multiple economic cycles to be able to, prove out, our loss profile. So I think, if investors are reticent, it's because they're, trying to understand the risk and make decisions appropriately.
One last question. This is for Azba. Would you be able to tell us anything about the partnership with Santander, and is that expected to launch? That is expected to launch in the UK.
Yeah, so it's actually already launched. It launched in August of this year, so that was one of the white label relationships that I mentioned. We are essentially providing the small business piece of the portfolio for Santander through our platform. So Santander has essentially licensed the white label platform. It was a relatively customized effort in terms of what they wanted to see on the credit box. We also do some customer servicing for them, which is really awkward because our people are having to come at like 3 a.m. in the morning to do customer servicing. But nevertheless, it seems to have worked out really well so far because we know our product pretty well. But yeah, that was a really great relationship. We're actually talking to them about launching in another country right now as well. And that was, one of the many financial institutions that we've worked with.
Okay. All right. Thank you all very much.